Let's get right into it. Expert analysis indicates that transitioning an active business to a specific pass-through corporate structure is a remarkably powerful financial mechanism. But, as we'll see, it's also strictly regulated. In this explainer, we're stripping away all the technical jargon to zero in on the core mechanisms, the implicit assumptions, and the exact cause and effect relationships that actually govern this high-level tax efficiency strategy. If you're looking for actionable, expert-level insights into how wealth is legally insulated and optimized at the corporate level, well, you are definitely in the right place. Okay, here's our analytical roadmap for today. We're going to break down the pass-through tax advantage, the income bifurcation strategy, the strict rules for corporate status, the annual filing ecosystem, and finally, shareholder loss and basis limits. Section 1. The pass-through tax advantage. This is the fundamental engine that makes this entire corporate structure tick. To truly grasp this, you have to look at the cause and effect of the pass-through election. By making this election, you are effectively eliminating the entity-level double taxation penalty. You see, in a standard corporate model, the business acts like an independent taxpayer getting hit with a tax bill, and then you, the owner, get taxed a second time when you take dividends. The pass-through election completely rewires this system. It transforms a corporation into a tax-exempt funnel. The entity itself literally pays zero federal income tax. Instead, 100% of the financial results, all those profits, losses, and credits, flow directly through to the individual shareholder's personal tax returns. This single-level taxation is absolutely crucial. It's the primary structural catalyst for retaining your wealth. Moving right along to Section 2, the income bifurcation strategy. Now, what's genuinely fascinating about this structure is how it empowers owners to strategically and legally divide up their revenue. The analysis highlights a core insight here. Once your net profits consistently clear that $50,000 to $60,000 hurdle, bifurcating or splitting your income becomes an incredibly efficient strategy. Because you are legally acting as both an employee and a shareholder, the revenue gets split into two distinct buckets. Bucket number 1 is your mandatory reasonable salary, which compensates you for the actual literal labor you put in. Bucket number 2 is the profit distribution, essentially the return on your investment in the business. Grasping this deliberate split is vital, because the tax code treats these two buckets in completely different ways. Now, while the exact numbers will shift depending on your specific financial goals, expert analysis frequently points to a highly optimized ratio, capping that mandatory reasonable salary at roughly 30% of your net profits. This isn't just guesswork. You absolutely have to pay yourself enough to avoid regulatory red flags, meaning no, you can't just work for free to dodge taxes. But the implicit assumption here is that every single dollar you can legally allocate to that 70% profit distribution bucket represents a massive calculated efficiency gain. And here is the exact reason why. Those profit distributions completely bypass the standard 15.3% self-employment payroll tax. Think about that. If you were just operating as a standard sole proprietor, every single dollar of your profit would be penalized by this 15.3% tax. But by utilizing the pass-through structure and leveraging this bifurcation strategy, only your 30% salary portion takes that hit. That remaining 70%, it escapes that specific liability entirely. That right there is the undeniable, explicit mathematical advantage of this whole setup. All right, Section 3, qualifying for corporate status. To actually unlock this financial engine, your business has to navigate a very rigid set of prerequisites. According to the analysis, this status isn't just a default right you're born with. It's an exclusive election that demands rigid adherence to structural rules. The legislative intent here is crystal clear. This benefit is restricted to domestic small to medium enterprises, not massive multinational conglomerates. For instance, if you have a standard corporation or a partnership sitting on your cap table as an owner, boom, the entire pass-through structure instantly collapses. On top of that, every single allowable shareholder must unanimously sign the election document, no exceptions. So you might be wondering what actually happens if a business misses the incredibly strict timeline to make this election. It's a surprisingly common risk, but thankfully compliance relief mechanisms do exist. The system knows administrative blunders happen, but this relief is absolutely not automatic. To secure retroactive validation of this tax advantage status, an entity has to execute these highly specific recovery steps. The implicit assumption baked into the rules is that the business must have been acting as if it already had the status all along. You literally have to prove a reasonable cause for missing the deadline, act immediately to fix it, and, this is the real kicker, you have to secure statements from all shareholders confirming they've consistently reported their personal taxes in alignment with that pass-through intent. If you don't have that universal alignment, your request for retroactive relief is going to be denied.
Section 4. The Annual Filing Ecosystem. Getting this status is just step 1. Maintaining it requires surviving a precise, continuous cycle of document filings.
This timeline exposes the critical, often non-obvious rhythm of compliance for these entities. Do you see the pattern here? 2.5 months is the magic number. The initial election has to be made within the first 2.5 months of the tax year, and consequently, your annual corporate return is due 2.5 months after the tax year ends, which for a standard calendar year drops right in mid-March. This is a deliberate design to ensure shareholders get their pass-through data well before their own personal tax deadlines.
The documentation flows downhill in a very strict hierarchy, ultimately pushing the raw data directly to the individual owner's tax level. The corporate return itself is purely an informational document. It simply calculates the aggregate health of the business, total profits, total losses. But the actual tax trigger, that's step 3. The individual schedules generated for each owner based exactly on their ownership percentage. That document is what translates theoretical corporate data into very real personal liability. Now, it is absolutely vital to note that there's a pressure release valve built into the system. Expert analysis reveals that if your operation stays under a $250,000 threshold in both total receipts and end-of-year assets, you legally bypass some of the heaviest administrative burdens. You are often totally exempt from filing complex balance sheets and intense reconciliations. This is a deliberate structural relief mechanism designed specifically to lower the friction for genuinely small operations.
Finally, Section 5, Shareholder Loss and Basis Limits. This is where surface-level understanding falls apart and where we really need to look at the hidden risks that cap shareholder benefits. One of the most common, non-obvious traps is that a shareholder literally cannot deduct corporate losses that exceed their calculated basis limit. What is basis? It's your real economic skin in the game. It's calculated by taking your initial capital contribution, adding any pass-through profits you left in the company, and adding any direct personal loans you've made to the entity. If the corporate return passes down a $100,000 loss to you, but your calculated basis is only $40,000, well, you can only deduct $40,000. That remaining $60,000, it's suspended. The system won't let you deduct phantom money. And even if a loss successfully passes through the corporate return, it still has to survive 3 expert-level filters or it gets trapped. First, it hits that basis limitation we just talked about. If it survives that, it hits the at-risk rules, which verify that your capital is actually truly at risk of economic loss, meaning non-recourse debt doesn't count. And finally, if it clears those 2, it hits the passive activity filter, which ruthlessly scrutinizes your actual operational involvement in the daily business. To actually bypass those passive activity limitations, you generally have to prove material participation by logging more than 500 hours of actual work in the business during that tax year. This is the explicit quantitative hurdle you have to jump to prove you're an active operator and not just a silent investor sitting on the sidelines. If you can't prove 500 hours, any resulting loss is classified as passive, which severely restricts its immediate utility by only allowing it to offset other passive income. As this data clearly shows, there is a drastic mathematical cause and effect relationship between your operational involvement and your ultimate tax liability.
Clear that 500-hour hurdle and your losses become active, offsetting other income sources and providing immediate financial relief. But fall short? Those losses are completely suspended. They are trapped on paper, forced to carry forward year after year until you either miraculously generate passive income or completely dispose of the corporate asset.
So as we wrap up this analysis, it all comes down to a fundamental tension. The tax savings of bypassing that 15.3% liability are mathematically undeniable. But actually unlocking those savings requires executing a flawless, continuous strategy of rigid compliance and operational awareness. You have to survive the ownership rules, the basis filters, the at-risk limits, and that 500-hour material participation test. The structure demands absolute precision. So looking at your own corporate footprint, you have to ask yourself, is the theoretical advantage of income bifurcation really worth the rigorous compliance ecosystem required to maintain it? Do you have the operational discipline to turn this legal theory into literal retained wealth?